looking at a special report, Forget Bitcoin Mining, Why WULF's AI Strategy is a Game Changer.
Right.
It argues that TerraWulf is pivoting from a Bitcoin miner to a high-growth digital infrastructure company.
A pretty massive thesis. And I think the report makes a good case for the growth narrative, but the defense. The defense needs to be stronger. Let's start with the financials.
Absolutely. The legacy numbers are, well, they're a huge anchor.
When you're arguing for a quality shift, you have to tackle that baggage head on.
So the report points out the net loss, what is it, around $455 million?
Yeah, and the long-term debt, $2.2 billion.
Yeah, and it tries to brush it off as, typical for an infrastructure build phase.
Which feels a little too easy, a little too generalized for numbers of that scale. It really does. So I think the first point is this. The presentation of financial risks, particularly the massive debt load and headline net loss, requires a more aggressive and detailed mitigation strategy within the report itself to maximize reader confidence.
Exactly. The weakness here is relying on that generalization. An institutional reader, or any reader really, sees a $2.2 billion debt figure next to a name they still associate with crypto.
And the alarm bells go off.
Right, and just saying, oh, it's non-cash depreciation, that doesn't really quiet those alarms.
Not at all. So the suggestion, I think, is to integrate those scary numbers directly into the main thesis, the predictable cash flow from AI hosting.
Okay, so you use the new, stable contracts to diffuse the old, volatile numbers.
Precisely. You weaponize the stability.
How do you do that specifically? I mean, what does that look like on the page?
Well, for one, you have to move beyond just labeling the loss as good because it was CapEx. The report should explicitly quantify the return on that investment.
You mean like calculate the annualized revenue you get from the Fluidstack and Google deal and put that right up against the cost of building out Lake Mariner?
Yes, do the math for the reader. Show them exactly how that sunk cost translates into future guaranteed profit. It completely reframes the narrative around that loss.
Okay, that makes sense. It turns it from a liability into a calculated investment with a clear ROI. But what about the debt itself? That $2.2 billion number is still sitting there.
Yeah, that's the real headline risk. You have to tackle that number head on.
So what's the tool for that?
The report should introduce an estimated debt service coverage ratio, a DSCR. And, this is the key part, base it only on the secured long-term contract revenue.
The 10-plus year deals.
The 10-plus year deals. You're showing the safety margin. You're showing that even if everything else went sideways, the core infrastructure business,
The new business.
underwritten by investment-grade clients, can comfortably cover the debt. It changes the debt from this terrifying, abstract number into a manageable metric.
And that makes the whole flawless execution risk feel less daunting because a big chunk of that cash flow is already locked in.
That's it, exactly. You neutralize the existential threat of the debt, and then suddenly the remaining Bitcoin mining operations, they stop looking like a primary risk and start looking like, well, an upside option, a bonus.
A much stronger financial defense. So, okay, if the financials are solid, what about the competition? Why can't someone else just do this? That brings us to the moat.
Right, the competitive advantages. And the material has a good foundation here with scarcity value, but it just doesn't hit hard enough.
It kind of pulls its punches.
It does. Which leads to our second point. To fully leverage the scarcity value argument, the report needs to make the contrast between WULF's existing power capacity and the specific challenges faced by competitors or new entrants much more explicit and vivid.
So the report identifies the two key advantages, right? Speed to market, because the grid connections are already there.
Yep.
And the zero carbon energy, 91% hydro and nuclear. But the weakness is that it's all a bit general, saying building a new grid connection takes years is true, but it feels
Theoretical. It lacks punch, especially when you think about how desperate the AI sector is for power right now.
So the suggestion is to make it painfully specific.
Yes. Ground that time to market advantage in hard numbers, in costs. You have to translate WULF's speed directly into a dollar figure or a time saving for the hyperscalers.
Okay, give me an example. What would you write?
You could quantify the value of bypassing that grid construction. For instance, state the average time and cost, in months and millions of dollars, to get a new 100-megawatt connection in that same region.
Right, so you're not just saying we're faster, you're saying we save you 18 months and $50 million in interconnection costs.
Now you're talking. That's a language a CFO understands. It turns a physical asset into an immediate, massive opportunity cost saving.
That's a much more powerful frame. And you'd do the same thing for the clean energy angle?
You have to. It's not enough to just say it's clean energy and that hyperscalers have ESG goals.
You have to connect it directly to their problems.
Exactly. The report needs to state that WULF's zero-carbon power directly reduces the client's regulatory burden or their carbon tax exposure.
Oh, so you bring in things like Scope 3 emissions targets.
Of course. A cloud provider is responsible for their supplier's energy footprint. So by signing with WULF, they're not just getting power, they're solving a huge compliance headache. It makes WULF a superior compliance solution, not just a feel-good one.
That really sharpens the moat. It's not just about having power. It's about delivering de-risked, time-compressed, compliant power.
Right. It's about solving the client's biggest bottlenecks.
Okay, so we've shored up the financials and we've sharpened the competitive moat. Now let's talk about the structure of the argument itself, how it's presented.
Yeah, the sequencing of the evidence. This is crucial. The report's whole game-changer idea hinges on this quality shift.
From crypto to infrastructure.
Right. But the single strongest piece of proof for that shift is kind of buried.
You're talking about the Google credit guarantee.
Of course. The fact that the counterparty risk is essentially investment grade. That validates the entire thesis, but it's just a secondary bullet point deep in the report.
It's a huge mistake in placement. It delays the aha moment for the reader.
It forces them to read the whole opening as a speculative pitch when the proof is already in hand. So, our final point. The placement and emphasis of the Google credit guarantee, which fundamentally validates the entire infrastructure giant theses, should be moved earlier in the argument to frame the quality shift immediately.
So the suggestion is simple. Move it up, lead with your strongest card.
Right. You follow that initial game-changer claim in the executive summary with the concrete proof. You reframe the whole discussion from the get-go.
And the entire piece is then read through a different lens.
A completely different lens. If the reader knows within the first 2 paragraphs that this company has a deal underwritten by the credit quality of Google, they stop thinking of it as a risky crypto miner.
And they start analyzing it as a legitimate infrastructure utility.
Exactly. And then all the other data, the DSCR you calculated, the competitive moat arguments, it all lands with so much more force because the quality shift is already an established fact, not just a goal.
So in terms of an actionable edit, you'd reorder the strategy section.
I'd lead with the Fluid Stack deal, but specifically headline the Google credit guarantee. Make that the hero. Allow the report to declare WULF an investment-grade infrastructure play on page 1, and then spend the rest of the report proving why that's just the beginning.
Is it important to separate the Google guarantee from the Fluid Stack deal itself?
Critically important. That's a great point. The Fluid Stack contract is the volume, sure, but the Google credit guarantee is the quality. That distinction has to be crystal clear.
Use it as the hinge, the central point of the whole introduction.
Yes, that single detail, this rare institutional validation, defines the quality shift up front and dictates how the reader interprets everything that follows. It makes the game-changer title feel earned from the very first page.
It's the difference between a story about a pivot and a story about a validated transformation.
Exactly right.
Okay, let's recap. The material here makes a really strong case for TeraWulf's new direction, highlighting the scarcity of their power and the quality of their new contracts. To really maximize its impact, we're suggesting 3 core refinements.
First, you have to get aggressive in mitigating the debt and the losses. Use those long-term contracts to build out a debt service coverage ratio. Give the reader that financial comfort right away and neutralize the shock of that $2.2 billion headline.
Second, sharpen the competitive moat with quantification. Translate that speed to market advantage into real dollars and months saved for clients, and link the zero carbon power directly to solving their regulatory and compliance burdens. Make it a solution, not just a feature.
And finally, restructure the argument to lead with your strongest proof point, the Google backstop. Put that validation right at the top of the executive